financial statements. Having said that, it does not mean that if we are unlisted company having a net worth of more than 250 crores, or if we are listed company who is wanting to present, we would have already presented in June 2019. We should not be waiting till March 2020. We need to be ready from now, and we need to do all the impact assessment of implementation of Ind AS 116 and try to make sure that we basically inform the entire management, because it is going to be a big change. First of all, we need to understand that accounting does not drive the business drives the accounting, and that is the whole essence of this Ind AS 116 and IFRS 16. So what's going to happen, right, guys? So friends, this particular implementation is going to impact the retail industry the most. Now, while I am saying that it is going to impact the retail industry, all industries who are heavily dependent on leases like telecom, airline, IT industry, who is having any kind of leases, are going to get impacted because of the introduction of the specific standard. Now, this standard is not only going to have an implication on the accounting aspects, but it is also going to impact the business. So let us move forward and see how it is going to impact the business, right? Okay, so what is lease? Okay, so lease, it was not specifically defined in the previous standard. So quickly, and one comfort what I can give to all of you is, whether we see the definition of a lease and whatever new definition we see in the new literature, whatever leases you are considering in the erstwhile literature, the consideration of a lease or the definition of a lease is not going to change for all of you, and this has been certified by several professionals, and my analysis also shows that the lease, whatever you have classified in the previous standard, is going to continue to remain as lease in the new standard also. So the only difference is, the new standard has given a specific literature that what are the criteria for a particular contract to be termed as a lease. So the criteria are very simple, that the asset has to be identified, that is, there should not be any substantive rights to substitute, and the customer should control the use. Simple example, if you get any server, if you take any hosting, okay, and if you pay hosting fees and server fees, that is not a lease, because the control of this entire transaction is there with the supplier. Customers don't get any control on this, they only get a space. Similarly, in any airport or in any stadium, if you get a specific booth or if you get a specific center to be accommodated, that is also not a lease, because it is only a space what you get, and the supplier has got the complete rights to substitute that at any point of time. A simple lease, whatever is being considered, like lease of premises, lease of office equipment, lease of computers, lease of servers, everything is going to come under the radar of IFRS 16 and Ind AS 116, and whatever transactions you were classifying it as leases in the previous standard, that will continue to remain as leases in the new standard also. So what is the big change, right? So in the erstwhile standard, there was a concept of operating leases, finance leases, right? Once upon a time, long ago, in our CA syllabus and in all the professional curriculum what we have learned, we have always studied that operating leases, the ownership is always with the lessor, and the lessee basically has the right to use. So the accounting was very simple, that street lining was done under AS 19, right? So AS 19 told categorically that you need to consider the lease term, and under that lease term you have to basically straight line the entire rental expenses or amortize the entire rental expenses. So operating lease accounting was very simple, but there were certain nuances which we can discuss in the subsequent webinar also. Now, whatever leases are not operating leases could be classified as finance leases. So finance leases, there were specific conditions, right, where there is a right of ownership, where there is a bargain purchase option which is there, where the minimum lease payments is almost equal to the fair value of the asset what is being taken on lease on day one, right? These were the criteria which were there for classification of a specific lease as finance lease. Now, what was the accounting for finance leases, right? So the operating lease accounting was very simple. You were debiting the rental expenses and you were crediting the bank account whenever you are paying the rental checks, and the differential was being taken as a provision, and the provision used to come down as and when the actual escalation used to happen in the rental agreements, right? And as far as finance leases are concerned, the asset always used to come in the books of the lessee. That means the lessee used to become the effective owner of the asset. So the leased asset used to get capitalized on day one and we used to depreciate it over the lease term, right? And then it used to follow the finance lease accounting, which was typically like a loan EMI schedule, where you used to break up the monthly rental payments into interest and principal. To the extent of that interest expense, it used to be a finance charge, and to the extent of that principal repayment, it used to reduce the lease obligation what you used to recognize on day one. This was the finance lease accounting which was followed under Indian GAAP. Now, what does Ind AS says? Ind AS 116 says very categorically that no more this jargon, no more accounting of any leases, operating leases, right? Provided that lease is for the long term and more than 1 year and are high value leases, right? All leases basically will be termed as right to use assets, okay, and the accounting would be similar to what we used to do in finance leases. So we have to understand, friends, that the accounting, whatever we are doing under the new standard, it is going to be similar to the finance lease accounting what we used to do in the erstwhile standard, right? So this new standard brings in the concept of right to use asset. I hope all of you will agree that it makes a lot of sense that if at all you are going to use a specific asset for the long term, effectively you become the owner in substance. And I believe in the firm philosophy that every accounting transaction has got a commercial substance. So if you try to explore this specific literature commercially, it clearly says that if you are using a specific asset for a specific term, and if it is going to cover the majority of its economic useful life. For an example, if a specific office equipment or a server is taken on lease for a period of say 5 years, its useful life itself is probably 6 years. So what is the intention of the lessor? Lessor wants to give away the asset, right? So in substance it is a finance lease. So friends, what is changing in Ind AS 116 and IFRS 16? They say that substance over form. You need to account these leases as finance leases only. So suddenly what is going to happen? My balance sheet is going to look heavy. When I say my balance sheet is going to look heavy, every lease transaction, and get it straight friends, every lease transaction is going to appear in the balance sheet as right to use asset, and the corresponding leg is going to go to lease obligation liability. Now there are only two exceptions which are permitted under the standard for short term leases which are less than 12 months, and the second exemption is low value items, and in IFRS it is categorically defined as $5,000. Now you will have a question, what kind of transactions will fall under this? All your procurement of chairs, and I believe in a lot of practicality, so that's the reason I am giving you all practical examples. Like if you purchase certain chairs which hardly cost $1,000 to $2,000, or there are certain low value asset like RAM or whatever you purchase, there are two choices. Either you can amortize it over a period of 12 months, or you can charge it off or fully depreciate in the month of purchase. So that purely depends on the company policy or the policy choice what you adopt. So the moment, one aspect what I want to cover is, the moment I say that all your assets and liabilities are going to come in the balance sheet, suddenly what is going to happen, guys? So all your stakeholders like tax guys, shareholders, investors, management, CEO, their antennas will suddenly go up, because all your ratios, right, including gearing ratio, the moment you take something on the liability side, your gearing ratio is going to go up, your debt equity ratio will go up, your current asset to current liability will undergo a change, your asset ratios will go up, whatever ROC, return on capital employed, that will go down because you are basically increasing the liability portion also. And the major change, when I say major change, it is actually going to change the situation of a company from a metric perspective and from a measurement perspective. Friends, all of us might be a part of unlisted companies or small companies today, but we have to definitely understand and contemplate that whatever changes are happening in the accounting standard, it has got an implication on the business and commercial standpoint, right? When I say this, the most important metric which is being driven by many companies is EBITDA, that is earnings before interest, depreciation, tax and amortization. that will undergo a change, because the perspective of companies disclosing a lot of leases as finance lease under Indian GAAP was to show an optimal EBITDA as compared to being shown on operating leases, because under operating leases the lease rental expenses always used to get amortized and it used to go above the line. When I say above the line, it used to get debited to rental expenses, right? And under finance leases, two components used to be there, that whatever lease asset you are recognizing on day one, that used to get depreciated, and on lease obligation you used to debit the interest expense. Friends, all of us know that depreciation and interest is not a part of EBITDA, it comes below EBITDA. So by virtue of this, the EBITDA margins in case of finance leases is higher and it is favorable to the company. Coming to Ind AS 116 and IFRS 16, suddenly you will see the operating margins of all the companies going up significantly because of this change. Now, the antennas of all the statutory agencies is suddenly going to get triggered and they will start feeling that, why suddenly the EBITDA margins are improving. Friends, you also need to consider the implication of this on income tax, because income tax unfortunately in India is not completely aligned to the financial accounting system what we have, because we always have this husband and wife fighting with each other in the form of MCA, which is Ministry of Corporate Affairs, and Central Board of Direct Taxes, which is CBDT. On one side, if I take certain accounting standards under the guidance of MCA, CBDT suddenly comes with their own ICDS, that is Income Computation and Disclosure Standards, right? By virtue of that, okay, since there is a difference between the thought process of both, this particular accounting treatment also is going to have an impact on income tax, because the income tax are going to tell very clearly that I am not going to consider this lease accounting what you are doing, I am going to go by the substance of the contract, and you have to decide from an income tax perspective that it is going to be a finance lease or operating lease. Now, majority of the times, okay, this is a practical standpoint what I have, because it is open to litigation in future, because this is the first year of implementation. Whatever we do, the finance lease, the accounting for right to use asset or the new leases under Ind AS 116 is completely similar to what we used to do in finance leases. So if they were allowing the accounting of finance leases under income tax, there is no reason for me to believe that they won't be allowing this under Ind AS regime, right? The second biggest change, all the covenants, debt covenants, the bankers, okay, they will suddenly get up and say your ratios are significantly changing, and on a daily basis the ratios what is going to get impacted is for banks and NBFCs, because they have to report all these ratios to the RBI on a periodic basis. So this is the kind of implication what we are looking at. And one twister what all of you are supposed to think is, if the operating margins are going to go high and I am going to take all the charges below EBITDA, what is going to happen in transfer pricing? Because transfer pricing works on operating margins, suddenly I will have a larger increase as far as operating margins is concerned. So my TNMM ratios will change and I'll have to accordingly explain the TPO, transfer pricing officer, about this accounting. So it's a big gamut of change what India is witnessing, friends. So all of you, mind me, all of you need to understand the implication. It is not only relevant for the financial accounting and reporting guys, it is very much relevant. The understanding of IFRS, Ind AS 116, Ind AS and all the accounting is very much necessary for all the taxation guys, investment bankers, M&A guys, because there is also articles available on the internet of the impact of the standards on the valuations, because the moment you take this particular transaction to the balance sheet, suddenly your valuations are going to change. So let us take one particular case study, and before that let us see what are the main components as far as the accounting is concerned. Now the first component, of course, whenever we do any lease accounting, is going to be the lease term, right? So lease term, the first relevant concept is the non-cancelable period, because the straight lining also what we used to do was always for the non-cancelable period, right? Now non-cancelable period is the initial period where there is a lock-in, and if there is a reasonable certainty, and if the lessee is reasonably certain to exercise option to extend the lease term, because practically speaking all the lease agreements or all the lease deeds will definitely have the specific term or specific renewal option which is being given to lessee, or that option is with the lessor. So wherever the option is with the lessee and the lessee is reasonably certain, in this situation the option, okay, so there were various arguments as far as Indian GAAP is concerned, and this is not a gap difference, friends, as far as lease term is concerned. There used to be a lot of arguments in saying that what is a typical lease term, if there is a lock-in, what is the lease term what we take. So there was a guidance note from AAC also, that is Expert Advisory Committee under Indian GAAP, where they have given very explicitly where if the lessee is reasonably certain that he is going to renew the lease and he is going to stay for a longer period, he can definitely consider that portion also as lease term. So two criteria from a literature perspective: if the lessee is reasonably certain to exercise option to extend lease term, and or reasonably certain not to exercise option of termination. So that period also needs to be considered as lease term. So the straight lining used to happen over the lease term. Even the lease term under the new guidance or the new standard of Ind AS 116 will be the same lease term what we used to consider for the previous literature or the previous accounting. That is one clarification what I am giving today. Lease liability. So what is typically lease liability? It's simple. Whatever you used to consider for finance lease, the lease liability will be one and the same. It is simple. The payments that is going to be paid over a period of the lease term, okay, the present value of that, the value of 1000 rupees what I am going to pay over a period of 10 years, if I discount it as of today considering the time value concept, it is not going to be the same. It will obviously be lesser than 1000. The same concept is there over here also, that you have to basically discount all your future cash flows, bring it to the present value and account it as right to use asset or the lease liability, right? So when you discount the entire minimum lease payments whatever is there over the lease term, there needs to be a discounting rate, right? So discounting rate, there are two options. The first option is basically you take interest rate implicit in the lease. None of the lease agreements practically can have this rate, okay? So in absence of this specific rate, we have to take something known as incremental borrowing rate. Simple concept: whatever bank borrowing rate is there on your loans, that is the rate what you have to take. If that is also not available, if you go to the market, what is going to be the borrowing rate that is going to get applicable for me? That is going to be your discounting rate, right? And subsequent measurement of this is going to be an effective interest rate. Effective interest rate is a specific concept under IFRS 9 which we will be covering over a period of time under this knowledge series. Third concept is right of use asset. Now all of us understand what is lease liability, blah blah blah, but what is right to use asset? Right to use asset is the leased asset what you used to create under finance lease. The same asset will be known as right to use asset under Ind AS 116 and IFRS 60, right? So right to use asset will comprise of lease liability which you are discounting plus initial direct cost what you are going to pay to acquire the lease. It can be in the form of stamp duty, it can be in the form of registration, it can be in the form of a certain leasehold improvement what you are doing in order to occupy that premise, plus certain prepayments, plus cost of dismantling. Cost of dismantling, friends, is a very important concept which is, hovering from the fact of property, plant and equipment, where we take a provision for dismantling on day one. That also needs to be considered under right to use asset. Minus any incentive received is going to be my right to use asset, right? Let us take a simple case study, right, where lessee ABC enters into a contract with lessor XYZ for the right to use office space for the 10-year term. The right to use the office space is a lease and there are no other components of the contract. The following facts are relevant at the lease commencement date. Simple case study. Let us focus, guys. Lease payments is fixed payments of USD 14,527 US dollars per year in arrears with a 3% increase every year after year 1. That means number 1, all of us know there is an escalation of 3% every year. Okay. Renewal option is 5-year extension. Payments during that period are USD 19,523 per year in arrears with a 3% increase every year after year 1 of the extended period. Lessee's incremental borrowing rate has been given explicitly as 10%. The rate implicit in the lease cannot be readily determined. They have given the same thing. So this is the rate which we will be considering for discounting the liability. Initial direct cost of the lease is USD 5,000. Determine the amount of right to use asset. Okay. Now they have given categorically about the assumption. I have put it as at the commencement of the commencement date of the lease, lessee is not reasonably certain to avail the extension option. When I say this, okay, this is peculiar to this situation where I have specifically told that the lessee is not going to exercise the option of renewal. Okay, so the lease term for all practical reason is going to be 10 year only, and I am not going to renew it, right? So let us look at the solution. Lease accounting under Ind AS 116. First of all, lease term. The non-cancelable period is the 10-year period which has been explicitly given, and the lessee is not certain to exercise the term extension, so that is the reason it is ignored. So the total lease term becomes 10 years. Lease liability, basically you calculate the entire 14,527, you plot it in a simple Excel sheet, you will get the answer. $14,527 with a 3% increase every year for 10 years. When you discount it for a period of 10 years at the rate of 10%, the present value of that lease payment is going to be $1 lakh. This $1 lakh, okay, becomes the lease liability, right? So this $1 lakh will be a lease liability which will be credited and which will be disclosed as a liability in the balance sheet. Now, in contrast to this, let's see what is right to use asset. Right to use asset is the lease liability, that is the present value of all the lease payments that you are going to do over a period of time, which comes to 1 lakh plus the initial direct cost of $5,000 what you are going to pay. Now this $5,000 can be of two types: stamp duty and registration, or leasehold improvements what I used to do. Friends, all of you need to be sure about the transactional difference what is going to happen under the new standard, because under Indian GAAP, if it was stamp duty or registration, you always used to charge off to P&L, okay, but if it was a leasehold improvements or any capital item, you used to capitalize it. But under Ind AS 116 and IFRS 16, this entire 5,000 will get added to the right to use asset, and it will appear as a item under property, plant and equipment as right to use asset. So look at the lease liability, right? So subsequent accounting is going to be, if you look at the amount of 14,527, it is the monthly installment or the monthly payment what I am going to do, right? So it is a typical home loan schedule. If you look at the home loan schedule, that is of the similar nature. You will calculate the interest on the first day as you used to do in finance lease and as you used to do in the home loan setup typically, where on $1 lakh, which is the present value of the minimum lease payments, you will charge interest of 10%. So in the first year, the interest become 10,000, that is 10% on 1 lakh rupees over $1 lakh. The total installment is $14,527. So the principal component is 4,527. Don't worry, don't get tensed. All these calculations can be done in a simple Excel sheet. Okay. Now, one of the complexities also that whether under the new standard, friends, I am giving you a comfort that under the new standard, the accounting technicalities is not very challenging, but what is challenging is the entire calculation of right to use asset, lease liability and transition provision. This is what is going to be challenging. Now, following this particular table, ultimately the balance has to become 0 at the end of 10th year, because over a period of time, the interest component goes down and the principal component goes up, as it happens in our personal home loan also. So right to use asset will be 1,05,000, lease term is 10 years, and the depreciation per year will be 10,500, which is 1,05,000 divided by 10. Look at the accounting entries. It is simple, nothing to panic. Accounting entry is depreciation expense to right to use asset 10,500, right? Interest expense debit 10,000. Sorry, lease liability will get debited by 4,527, and the bank account is getting credited by 14,527, which is an yearly payout. With all leases changing from operating lease to right to use asset, there will be a major shift in financials. Look at the balance sheet position, guys. Under the erstwhile provisions of Indian GAAP, you used to disclose, assume that the initial expenses is on leasehold improvements, so 5,000 gets debited to leasehold improvement under Indian GAAP, but under the Ind AS, the right to use asset is going to appear as 1,05,000. So suddenly your asset ratios are going to go up. Liabilities, equity is already 1 lakh, okay. and under Ind AS, equity will continue to remain 1 lakh, but the lease liability will have an additional impact of $1 lakh. Right? So right to use asset of 1 lakh is replicated on the liability side also. So it says that $1 lakh is going to get paid over a period of next 10 years with an incremental interest of 10%. Right? So look at the income statement. So income statement, all of us understand that the moment all the leases are classified as balance sheet or the finance lease accounting is followed, EBITDA margins is going to improve, which is very much evident through this calculation. That revenue, I have kept it as constant. Rental expenses 16,654, which is nothing but the straight lining impact of the 10-year lease payments. Right, other expenses 1,20,000. So EBITDA margin under the Indian GAAP scenario is 63,346. Now come to Ind AS. Right, other expenses will remain constant. The rental expense will become zero. Rental expense will become zero, friends, and it will appear as depreciation and interest. So in the first year, if you see, interest was 10,000 and the depreciation is constant with 10,500. So in the first year, depreciation is 10,500 and interest is 10,000. So EBITDA margin is basically increasing significantly and it is $80,000. However, the PBT is gradually going down because in the initial years the interest expense is going to be higher, and that's the reason in the initial years, if you compare the interest plus depreciation charge under the new standard, it will always be more in the initial years than the rental expenses what used to debit in the Indian GAAP scenario. So this slide is very important. The new leasing standard affects some critical ratios, including and not restricted to debt to equity. Right? So Ind AS, the debt to equity is going to significantly increase. Return on fixed assets, Indian GAAP was higher, but Ind AS is going to be lower. EBITDA, Ind AS it is going to increase. Indian GAAP was almost constant. PBT, Indian GAAP was higher and Ind AS will be lower because, as I said, the interest and depreciation will be higher as compared to the rental expenses. On net basis, there is no change in balance sheet. However, optically there is going to be a big change which results in significant change in ratios such as return on assets, debt to equity, and there is going to be a significant change in P&L as well. The EBITDA margins is going to be favorable for companies. Fall in PBT will only be in initial years, which is temporary. So this is the full overview, and just to move forward, interesting concept guys, that we have not talked about cash flow impact. Right now, what will be the impact of cash flow? We started with 63,346 and 59,500 from previous slide, which is the PBT. Now in cash flow you will add back depreciation and interest expense as far as Ind AS is concerned. Suddenly your cash flow from operations will significantly increase. Now cash flow from operations should directly be correlated to the improvement in EBITDA margins under the Ind AS scenario. If your EBITDA margins are going to improve, then optically your cash flow from operation needs to improve. Right? Now acquisition of right to use asset, that is the principal repayment of 4527, is going to become a part of investing activity. Right? And the interest component of 10,000 is going to become a part of financing activity. Friends, this is a big change what is going to happen in the cash flow statements of all the companies who is going to adopt Ind AS 116 and IFRS 16, and you please be ready to answer a specific set of questions from all the investors and shareholders. I am not scaring you, and there is nothing to be scared about this particular technical standard. It is only about the understanding what you need to develop over a period of time. Now the disclosure of future commitment towards lease payment used to be given under Indian GAAP, and under Ind AS, significant judgments and assumptions such as whether a contract contains a lease, standalone prices for lease and non-lease component needs to be given, because a multiple element deliverable is a buzzword as far as IFRS and Ind AS is concerned. Whichever contracts have got multiple deliverables, like we used to have in IFRS 15, even if a lease contract has got certain non-lease components like service or maintenance, that has to be carved out separately and accounted separately. The logic is the same, the standalone selling price needs to be evaluated, and accordingly the maintenance and service component needs to get accounted separately. Positive impact on cash flow is going to be there, and investors have to be aware of this. Implementation options, there are two options. Okay, so the first option is full retrospective method, retrospective to each period, where you have to apply this lease accounting as if you had applied it from day one. So all the financials will be restated, all the P&L will change, and all the liabilities and retained earnings will get changed, and the entire impact will have to be taken in the respective periods financial statements. 99.9% of the companies in India are not taking this option because no one wants to go back and reinstate all their leases what they have accounted previously. Okay, next method is modified retrospective method, where you take a cutoff, okay, and retrospectively with the cumulative effect recognize the date of initial application, effect of transition to be accounted on the retained earnings as of 1st April 2019. Now you have got two choices under modified retrospective method for calculation of right to use asset and lease liability. Either simply, which 90% of the companies are doing, you calculate the lease liability and equalize your right to use asset to lease liability, right, and pass a simple accounting entry, right to use asset to lease liability. Second option, for every lease whatever is there, calculate the minimum lease payments for the future lease payments which are pending, and calculate the lease liability as of the date of transition. Right to use asset also you have to calculate separately based on the initial period of the lease, and the differential will go to retained earnings, right. If the leases are less than 12 months, then the options will be to exclude them. Lease liability, discounted value of remaining future lease payments. Right to use asset, remaining lease liability with adjustments, and finance lease will continue to exist. These are the transition options which are available. And if at all, if there are certain prepaid expenses and accrued expenses which is there on account of the previous accounting, that has to be reversed and it has to be adjusted under right to use asset, whatever is going to be there on the date of transition. Aspects, critical aspects to be taken care of: identification of a lease and asset. Don't worry about this, as I said, and I am very confident about it. In 99.99% of the situations, the lease will continue to remain what it was in the previous standard as well, right. Segregation of lease and non-lease component, that is the second objective. Changing process, controls and systems to capture and maintain all necessary input for lease accounting. This is one important element of change what all of you will be going through right now also practically, right. So all of you might be facing a challenge of accounting this particular right to use asset and usage of Excel, right. So that's the reason there are tools available in the market. We have also developed one which is known as basically Leason, where we give a clear path to account all the lease transactions automatically through the ERP itself, right. So you have to roll up your sleeves and try to make sure that you align completely with the ERP guys who are internal to the organization, and make sure the entire lease accounting happens through the system. You can also do it in Excel, okay, and I can probably help to build you those Excels also, but Excels are never sustainable. Friends, Excels are never sustainable because as a part of your EU and the various controls and EOC also, Excel based spreadsheets which you have, that is also biggest risk what is going to hamper the organizations going forward, right. Accounting for modification of lease terms, you have to be very careful whenever there are modification, and you have to preempt all the stakeholders in the gamut of your organization, and you have to inform them, and you have to keep them informed about the various changes in ratios what is going to happen after implementation of the standard. These stakeholders can be the management, CEO, board, taxation guys, assessing officer, the company secretary team, because they also report certain ratios, and also the entire set of investors whom you have. Critical investors needs to be informed about this. And if you are a listed company, as a part of your quarterly reporting what you do, you need to add a line item that this particular accounting has changed your financials to what extent. That is a good practice of quarterly reporting what you do. So I'm sure that you would have enjoyed this particular session and you would have found this particular webinar useful. I will open the house for questions. Before I go through the course what we have, I would try to answer the questions whatever you have. So I'll open the house for questions quickly. If at all any participants have any sort of questions, it was a quick overview, but in this quick overview also, if I am able to sort certain questions, I am more than happy to do that. Of course, this is not going to end over here, friends, so don't think that I am going to do only one knowledge session and stop over here. We'll continue to do this, and with your support we will build a good IFRS knowledge base, and I want to create a good ecosystem of finance team and all the finance professionals being upskilled on various aspects of compliances and all the accounting standards and all the compliances what they generally go through. That is the objective of Finance First. So if at all you have any questions, please raise it and I will be more than happy to answer. Okay, then let me conclude this webinar by saying that you have been a wonderful set of audience, of course, and we'll continue to share this knowledge series, right? And I am sure that you would have found this particular webinar useful. I would request all of you to put your comments in the comment section so that we can get in touch with you if there are any queries. And also we are running a detailed IFRS course for almost 75 hours with 25 hours on pen drive also, and it will be a good knowledge sharing session which is going to start this Saturday. Nevertheless, even if you are not joining, I will continue to share my knowledge on every Saturday same time as a part of our webinar and if there are any changes, I will let you know subsequently. I will be more than happy to share all the knowledge that I have with all of you, and let us build a positive ecosystem for sharing all the finance knowledge what every one of us have. Thanks a lot, guys. We are good to close the webinar session, and in case if you have any queries, you can definitely get in touch with my office. Appreciate the time what you are given on a Saturday, and hoping to see all of you in the subsequent webinar session also. Thanks a lot.